So in this video, we're going to talk about the potential rise in capital gains tax and how it could affect you, and more importantly, what not to do. Hey, what's up guys, Dan Trevidi here, I hope you're all well. As ever, before we get started, if you could do me a huge favour and smash the like button, and don't forget to hit subscribe and the little bell icon next to it. So this week there has been huge amounts of press coverage about the potential capital gains tax coming into force in the November budget by the Chancellor to raid our piggy banks to pay for this huge tax bill the government is facing for the coronavirus. And you will recall this isn't the first time we've had this headline. A few months ago, it was in the papers, it was on the social media websites, and it was in the YouTube videos about what was coming. And it never actually did. It doesn't mean that it's not coming, it just means it's potentially been put back. And I do think it's going to be announced in the November budget. And look, I've seen some of the posts and some of the YouTube videos and press around this being a huge horror story for property owners and investors. And I personally don't think we should all run for the hills and start selling just yet. And here are the reasons why. So I've been reading some of the detail about this, and again, you have to look at the person who's making this decision, the Chancellor. Who is the Chancellor? What has he done previously? What has he done to create his own wealth? And I do think a lot of learning can be taken from how he's tackled and brought in new schemes to help people with the coronavirus and the pandemic. And it's not just a pull your gun out and shoot one target. It's a well thought through process that doesn't necessarily take the easiest ride for him, but it does explore multiple ways on how to get to the same place without impacting individuals or certain sectors directly, all on their own. So let's just check the facts for a second. So we know that the Chancellor has ordered a review on how he can simplify the capital gains tax process. And he's asked for that review to be pushed through as quickly as possible because he obviously wants to bring an announcement very quickly. Now, very simply put it, capital gains is the tax that you pay on a gain in your personal name when you materialise the profit, the gain. And it's not how much money they releases, it's purely on the gain. So this is really relevant for people who own a second home and have bought it for a price, maybe improved it or owned it for a long period of time, and it's gone up significantly in value, but they've refinanced. It's not the tax on the money that you pull out when you sell, it's on the total gain. Now at the moment, for property investors in your personal name, it's 18 or 28% depending on what tax bracket you're in. It's already higher for property investors than it is on standard taxable gains. And there are some things that are exempt, things like classic cars, vintage wines, all of these tax loopholes where super wealthy put their money in to avoid paying capital gains if and when they decide to sell, and there's some inheritance tax planning around that. So straight away, let's look at the assets that people sell that are not paying any capital gains tax. That's going to be one of the quickest and easiest wins for the Chancellor to bring in, which isn't going to cause too much disruption and is probably well anticipated by most of the people that currently hold assets in that sector that don't qualify for capital gains tax. The other thing is around the tax bracket and simplifying it. This word simplify, they're going to bring capital gains tax in line with each other if it does stay as a separate tax to income tax. And that is a big if, because even I'm not going to predict that one. But if it does, this 10 and 20% and 18 and 28% bracket for property and other assets is going to shrink into one type of tax, one type of capital gains tax. And I personally think it's not going to increase beyond 28% if, a big if, it's not brought in line with income tax. There's going to be one rate of capital gains tax for everything. Now here is the big thing that I do think is going to happen, and this isn't just based on opinion, this is based on some research and some numbers. Whatever the change to capital gains tax, whether it be one tax bracket for every gain or gains are moved into income tax, so it falls within the 20, 40 or 45% brackets, whatever that may be, the current threshold of tax-free capital gains every year, which is $12,300 per person at the moment, is either going to be scrapped completely or reduced within an inch of its life to £1,000 to £2,000. Some of the numbers that I've been looking into suggest that most people who pay capital gains tax at the moment is over 35s, and when you get over 50, that's a massive chunk of the capital gain. People who hold assets in their personal name for a long time that over time have increased significantly in value and go way beyond the tax threshold of where you having to start paying the higher rate. This is where we have to look at the Chancellor, because he knows that if he just increases the tax or moves it to the income tax threshold, which I don't think is really going to happen, but it could well do, don't get me wrong. But if they do increase that tax banding to a 40%, it's still only really going to affect that age bracket. And that age bracket, in terms of assets that they're going to be offloading, is going to shrink over the coming years, because people who are in that age bracket or are moving into that age bracket now hold their assets in a far more tax efficient way. Things like limited companies. When we had the Section 24 tax change to interest rate relief back in 2015, there was a huge amount of people affected, but not a huge amount of tax paid, because a lot of people took sound advice and have moved their assets into limited company structures. And if the Chancellor was going to bring in something which would be so one-dimensional and not well thought through, we could probably expect this. But the ripple effect of that is you would expect everyone to move their assets into a far more tax efficient structure. So the net gain for the Treasury wouldn't be as high as what they would forecast, because the reality is the delivered income from the Section 24 has not been as high as they had hoped, because everyone has been either buying more tax efficiently or moving their properties into a limited company structure. So the Chancellor will be well aware of this. And this is the Chancellor that wants long-term sustainable results that can have an impact, but don't necessarily bring a detriment to the people's behaviour that could encourage the economy to drive forward. And the worst thing the Chancellor could possibly do would be to stop people buying and selling assets because of the capital gains tax change. Now, this is where I'm not going to really put a hard prediction on what the change is going to be, because if it was moved over to the income structure on 20, 40 and 45% based on how much you earn, moved into the capital gains, would actually make a lot of sense on what I am going to predict, which is he is going to drop the threshold before you start paying it. He's going to reduce it from 12,300 to 1,000 to 2,000. And that drop is going to increase the amount of people who pay capital gains tax. So that is like trigger one, that he is going to start to get more people paying tax. And if you compare capital gains tax to how many people who pay income tax at the moment, it's something crazy like under 1%. So you've got everyone who pays income tax, and under 1% of those people pay capital gains tax at the moment. So the easiest thing for the Chancellor, and I think the path of least resistance, is to start to tax pretty much everyone who has a gain over £1,000 at either the same rate, capital gain, new capital gains tax, or everyone in line with income tax. So really difficult to predict which way that's going to go, but the reality is if it's going to be one capital gain, it's going to be similar to the higher rate of income tax. So whichever way it does go, it's not going to impact the net result completely. There just may be ways of deferring it and paying less tax depending on what the detail is. So really, those are my three things to watch out for. Is the assets where currently they're not liable to pay any capital gains tax if you do sell them. Second, homeowners or property investors that own properties in your personal name. Look, you must have known a change is coming. We said it when there was a change back in 2015. Capital gains tax was sort of next on the agenda after interest rate relief. If you haven't started buying in a limited company or moving stuff in a limited company, then it's kind of on your head, be it. Look, I still own property in my personal name. I've not got any intention to sell them because of the current capital gains tax, let alone an increase. So why would I even sell them? And I could always move them to a larger corporate structure if I chose to. But look, it is going to change. It is either going to come to a more simplified version, so property and other assets all fall in line with each other, and that could be anything from 28 to 38%, something maybe around the dividend rate, I don't know, or it could move over to the income threshold. So that means that even though the rate of 0% capital gains tax is going to be potentially scrapped or lowered, you have a higher threshold before you pay over 20%, which again is not better for property investors who are in the lower bracket, because at the moment, if you're in the lower bracket, you're paying 18%. If it moved over to income tax threshold, your lower bracket, you go up to 20%. But this is a fair chancellor, this is a good chancellor. He may reduce the capital gains threshold, or he may leave it to be in line with income tax threshold. So it does all move over. So again, not a huge kick in the teeth if you're falling within those tax brackets. I personally don't think that's going to happen because, like I said, one of the biggest wins and unfrowned upon and easiest paths for him would be to start to tax every gain, say over 1,000. That would triple, if not quadruple, the amount of people that he can tax at the moment, which means more revenue. So up for debate. Not going to call it myself in detail. I personally would put money on that it's going to be a single capital gains rate with literally no, if not a very small threshold before you start paying that gain. I don't think it's going to move into income tax because the two are completely different. Then to finish off the video, I guess the biggest thing for me is all of the people who are going to panic and either start offloading assets now to save a couple of percent. It's just not worth it. Remember, when the masses start to act, you need to observe and do the opposite. Now, one of the biggest things that I saw this in real time was when we had the stamp duty hike coming in a few years ago. And literally, people were paying 8 to 10% more for a property to save 3% stamp duty. That is how crazy this whirlwind of an environment can whip people up into a frenzy to act irrational. Now, the reality is, if there is going to see a net increase in your potential capital gain, look to the reason as to why you weren't going to sell anyway. Why haven't you sold already? And if that reason still is there today, then there's even more a reason not to sell. So don't just go off and sell to save a couple of percent. There will be a lot of people selling their properties, and the chances are they're going to be investment properties. So the rental income, HMOs, commercial property, whatever you want to call it, if a lot of those types of properties are going to hit the market at once, the prices are going to fall. It's going to be a buyer's market. So in order to save what could only be a couple of 3% on your possible gain, you may be taking a 5 to 10% hit on the price, which could translate into 15, 20% deduction on your gain just because you followed the masses and sold when you didn't need to sell. Personally, if I didn't need to sell a capital gain qualifying asset today and the tax increases, then I'm even more incentivized to hold on to that asset and not sell off that asset. I've seen a lot of things come and go over the last 3, 4, 5 years. Things like Donald Trump being elected in 2016 and then the Brexit vote being passed, Cameron resigning, Theresa May coming in, her being binned off, Johnson coming in, going through another election, him winning a majority, and then the coronavirus. We've seen a huge amount of change. And every single time one of these changes have come into play, I'm getting phone calls, I'm getting messages about people need to sell, I'm going to do this, I'm going to react before this happens, the world is going to end. And the reality is, it hasn't actually ever ended. People like you and me have just materialized and capitalized as entrepreneurial people when people don't act rational. And this announcement is going to be no different. So stay safe, keep your eyes on the numbers. Hope you found the content rich, and I'll catch you all on the next video.